In 2019, WeWork was valued at nearly $47 billion. Investors called it the future of work. The company expanded across the world at incredible speed. Luxury offices, celebrity investors, private jets, massive growth. Its founder, Adam Neumann, became one of the most talked about entrepreneurs in Silicon Valley. There was just one problem. Behind all the hype, many investors and analysts started questioning whether the company's business model was actually sustainable. And when WeWork finally attempted to go public, the illusion began collapsing almost immediately. Billions of dollars disappeared from its valuation, thousands of employees lost jobs, and one of the most hyped startups in the world became one of the biggest corporate failures of the modern startup era. But this story is not just about one company. It's about modern business culture itself. Because WeWork exposed something much bigger, how easily people can confuse growth, hype, and confidence with real value. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey. At first, the business idea sounded relatively simple. The company rented large office spaces long-term, then redesigned them into modern shared workspaces for startups, freelancers, and small businesses. Today, that concept feels normal. But at the time, co-working spaces were still relatively new, and Adam Neumann understood something extremely important very early. Office rentals alone were not emotionally exciting, so WeWork didn't market itself like a real estate company. Instead, it presented itself as something much larger, a movement, a lifestyle, a community. The company constantly talked about creativity, collaboration, human connection, and reinventing the future of work. That messaging became incredibly powerful because investors were not just looking at desks and office buildings anymore. They were looking at a company that appeared modern, visionary, and culturally important. And during the 2000s and 10s, Silicon Valley investors became obsessed with companies that promised to change the world. WeWork fit perfectly into that environment. To understand WeWork's rise, you also need to understand the broader startup culture during that period. For years, many technology investors prioritized growth above almost everything else. The logic was simple: grow as fast as possible first, then figure out profitability later. As a result, many startups focused heavily on expansion, attention, market dominance, and valuation growth, and WeWork expanded aggressively. New locations opened constantly, new cities, new countries, new buildings. The company's offices looked visually impressive: modern furniture, stylish interiors, open workspaces, free coffee, community events. Everything felt premium and modern. Young professionals loved the atmosphere. Media coverage became increasingly positive. And the faster WeWork grew, the more excitement surrounded the company. Because rapid growth itself often creates the appearance of inevitability. People start assuming if something is growing extremely fast, it must be valuable. And psychologically, that assumption can become very powerful. But underneath the excitement, some investors and analysts started noticing a major problem. WeWork's business model carried enormous long-term risk. The company signed long-term leases on office buildings, sometimes lasting more than a decade. Then, it rented those spaces to customers on much shorter-term agreements. That created a dangerous imbalance, because if economic conditions changed, customers could leave relatively quickly, while WeWork still remained responsible for massive lease obligations. And the company was expanding so aggressively that those obligations kept growing larger and larger. More buildings, more leases, more financial pressure. Meanwhile, the company continued losing significant amounts of money. According to its financial filings, WeWork lost billions of dollars while rapidly expanding operations. But during the startup boom, many investors remained focused primarily on growth. And as long as the company's valuation kept increasing, concerns often stayed in the background. One of the biggest turning points came when SoftBank invested heavily into WeWork. SoftBank, led by investor Masayoshi Son, became one of WeWork's largest supporters. The investment firm poured billions of dollars into the company, and that funding accelerated WeWork's expansion dramatically. The company started opening offices at extraordinary speed, but internally, reports also began describing growing chaos. Multiple media investigations later described concerns involving leadership decisions, corporate governance, spending habits, and company culture. Adam Neumann himself became increasingly famous. He was often described as highly charismatic, energetic, and extremely ambitious. But critics also questioned whether the company was becoming too dependent on hype, optimism, and constant expansion. At the same time, Neumann developed a reputation for an unusually extravagant lifestyle. Reports described luxury properties, private jet travel, and expensive corporate events. And despite the company's enormous valuation, WeWork still struggled to build a consistently profitable business. But during periods of intense optimism, people often ignore warning signs longer than expected, especially when massive amounts of money are involved. Then came the moment that changed everything. In 2019, WeWork prepared for its IPO. For years, private investors had supported the company enthusiastically, but public markets operate differently. Because once a company files for an IPO, its financial details become far more visible. And when investors examined WeWork's filings carefully, concerns exploded almost immediately. The company revealed enormous losses, its governance structure faced criticism, and many analysts began questioning whether WeWork should really be valued like a technology company at all, because fundamentally, the business still depended heavily on long-term real estate obligations. The IPO filing also revealed several controversial details involving Adam Neumann's control over the company. One widely discussed example involved the word "we." According to reports, Neumann had personally trademarked the word, and WeWork later paid him several $1 million for rights to the trademark before the payment was eventually reversed after criticism. That became symbolic of a much larger issue. Investors started questioning whether excitement around the company had overtaken rational financial analysis. And once confidence started weakening, everything changed extremely quickly. As scrutiny increased, WeWork's valuation started collapsing. The company that had recently been valued near $47 billion suddenly looked dramatically less stable. The IPO was eventually canceled. Adam Neumann stepped down as CEO. Layoffs followed. Expansion slowed heavily, and WeWork became one of the most visible examples of startup overvaluation in modern business history. At one point, the company's valuation dropped by tens of billions of dollars compared to earlier private market estimates. For employees, investors, and the broader startup industry, the collapse became shocking. Because only months earlier, many people believed WeWork represented the future of business itself. And that's what makes this story so psychologically fascinating. Nothing changed overnight physically. The offices still existed, the employees still existed, the company still operated. What changed was perception. And modern financial systems are heavily influenced by perception. WeWork exposed something much larger than one failed IPO. It revealed how modern hype culture often works, because modern business environments can become emotionally driven very quickly. When companies grow fast enough, people start associating speed with intelligence, valuation with legitimacy, and confidence with competence. But those things are not always the same. And WeWork became one of the clearest examples of that disconnect. The company sold a powerful vision, and visions can become emotionally intoxicating, especially during periods of optimism, especially when everyone around you also appears excited. Psychologically, humans are heavily influenced by social proof. If enough investors, media outlets, and influential people believe something, others naturally assume it must be valuable too. That dynamic appears constantly in financial markets, startup culture, social media, and modern internet culture generally. And sometimes, the appearance of success grows faster than the actual fundamentals underneath it. That doesn't mean every ambitious company is fake, and it doesn't mean growth itself is bad. But WeWork demonstrated how dangerous it can become when storytelling, valuation, and hype completely overpower sustainable economics. Because eventually, reality matters, profitability matters, cash flow matters, sustainability matters, and when those fundamentals remain weak for too long, even the strongest hype can collapse surprisingly fast. WeWork didn't fail because people stopped needing offices. And it didn't collapse because the idea sounded completely irrational. The dangerous part was that for a while, the story felt believable. The growth looked real. The excitement looked real. The confidence looked real. And modern business culture became extremely good at rewarding appearances long before reality catches up. Because in financial markets, perception can temporarily become more powerful than fundamentals, until suddenly, it isn't. And maybe that's why the WeWork story became so important, not because one company failed, but because it exposed how easily modern systems can confuse hype, momentum, and attention with actual value. And sometimes, the biggest financial illusions in the world don't look irrational at all while they're happening. If you enjoyed this video, subscribe for more stories about business, money, psychology, and the hidden systems shaping modern life.